And welcome back to another episode of WealthWise with me, your host, Jordan Kimmel. And it's Scott Martindale, a contributor both to the newsletter, an old friend, and the CEO of Sabrient Systems. And Scott, thanks so much for joining us.
Hey, it's my pleasure, Jordan. Thanks for inviting me.
All right. Well, I read your sector rotation note every month right now. I really appreciate you sharing it. I have to, for people who haven't seen the prior video, spend a minute on Sabrient Systems and your founder, David Brown, and his new book. And I will say publicly, I'll say it privately, David Brown is simply one of the smartest businessmen and one of the best actual investors I've ever met. And it's a testimony that you guys started this thing. You'll talk about the dirty dozen, I think you call it. But as a
Bakers.
result, not because you're good looking or not because you're fast with a quote, performance wise, you guys have done billions, billions, and multiple billions of product with all the manufacturers, whether it's the Nuveen or First Trust. It's a testimony to the style, more importantly, the results. Why don't you spend a minute on the Sabrient systems? I know you guys not only do Baker's Dozen, but you do a host of things using quantitative, systematic investing. And please share it.
Sure. So David Brown is our founder. He is a former NASA engineer. He worked on the Apollo 11 moon landing project. So, he's getting up there in years. He's been doing this for a long time. Made that switch like a lot of engineers do to building models to try and beat the market. Engineers with MBAs tend to think that they can outsmart the market. And I'm also a former engineer, former Chevron engineer, similar path, moving into the financial investment world. As a team, we leverage a process-driven quantitative methodology. And so we use that process-driven methodology to build multi-factor models, alpha factors that we've tested and feel like are robust for different market conditions, investor tools. We have proprietary data sets that we license out, and we have indexes for ETFs. And we create portfolios with sort of a combination of a quantitative with a fundamental overlay. We call it a quantamental approach. We use that to build portfolios where we actually hand select rather than let the computer do it at the end, although we use computer models along the way. And those are packaged as unit investment trusts and distributed by First Trust portfolios. And one of those, as you touched on, is not the dirty dozen. It's called the Baker's Dozen. It's a
There you go. Sorry about that.
stock portfolio. And that's kind of become our flagship portfolio franchise. And David talks about this approach, and our core approach is a growth at a reasonable price methodology, which is GARP. We also have value, small cap, dividend, and David talks about all of these approaches in his new book, which is called How to Build High Performance Stock Portfolios. It's available in paperback and ebook formats on Amazon.com. And it's geared toward investors of all levels. So I think anybody, no matter what your experience level, can gain something, whether there's enough information to be basic and enough information to be more advanced. And he talks about all these strategies and how we go about building models, including all the factors that we like to look at.
Right. Well, I think that's a perfect introduction. I'll say right over my shoulder is Magnet Investing. And I like to share the very first edition has a CD-ROM from Telescan, David's prior company. And this whole thing of factor analysis is embedded in everything I do. What I tried to do, Scott, is I tried to learn from the best that were out there, and David was one of them. And when I looked at the Baker's Dozen, it's interesting. A couple of those are in our portfolio as well. It doesn't surprise me. I've tried to incorporate several different factor analysis, several different methodologies from really the greats on the street. That's how I actually built Magnet. Now, what I want to talk about, what's really interesting, is even though every month you guys are on top of another data set, another product, another release, and you put out a piece, on sector rotation. I started to read it. I didn't complete it yet. You talk about the new administration, but I want to talk about the robustness of the product itself. Whereas a lot of people, embarrassingly, Scott, are trading on moving averages. It's embarrassing how lightweight that is, how prominent it has become. But what you're doing at your firm, for the most part, I believe, is portfolios that are tax efficient 12 to 15 months. So you have to have the confidence in the details of the analysis to say, we're not only going to buy this, we're going to hold this unless special circumstance might occur. You hold it for 15 months. That's a tribute to the depth of the factor analysis that you encompass. I just want to say that as a compliment. Maybe you want to embellish that a little bit.
Well, yeah, that's part of the the approach is that most active managers underperform the benchmark. So we're just trying to find stocks that are better, we feel are higher quality than what the overall market average is, and stick with those stocks. And yes, some of them maybe you'd like to be able to get rid of them, but there's others that sometimes over the course of a year or 15 months, they they show some weakness, and you might be tempted to sell them, and maybe that's exactly the wrong thing to do at that moment. So there's plenty of active managers out there with mutual funds and actively managed ETFs and everything else, separately managed accounts. Our approach to holding for a year, 15 months is just a way of, in my view, of diversifying that equity exposure into something that's not the active trading. When you talk about moving averages, exactly, that it's great for trading, but for us, we really want to just focus on quality, high quality, based on strong fundamentals. When I talk about strong fundamentals, I'm talking about accelerating sales and earnings, rising margins, rising free cash flow.
Mhm.
We like to look at the analysts who are following these, and the consensus of those Wall Street analysts who are following these companies, and look for positive revisions. Companies are getting upward revisions to their estimates. Those are the sorts of things. Low debt, the types of factors that we use in our models, and that point us in the right direction.
Right. And so what's really fascinating here, and some people will think that, I copied or pasted, whatever. Every factor you just mentioned is in my model, in addition to several others. And I like to say that I came around too late to invent the wheel, or the tire, but if you take all the best tire manufacturers and ask what they're doing right, what's the best aspect of each tire, you can create your own tire. Mine's called Magnet, but I've learned a tremendous amount from Telescan and putting in searches and see what comes out. And then you could reverse that search and see what characteristics. And it was an ongoing actual love of mine. And I just that's how far we all go back. Now, let me just bring it a little bit to present day right now, because you do put out a lengthy piece every month that you share with your clients and your list, and we're trying to use an abbreviated one in our newsletter. Is there anything now, like I'm saying, current? Forget about stocks, forget about what picks coming to the surface, but in terms of the sector, the economy, this new administration, and things that might present extra good opportunities now.
Well, yeah, our model has definitely started to reflect what you might call Trump 2.0. So we have a sector cast model where we aggregate all the individual stocks within ETFs, and we rank those sector-based ETFs. And we're definitely seeing, technology, just with its really strong return ratios and margins, always tends to rank pretty highly in our model when the economy is solid enough and the stock market is bullish. But we're also seeing the cyclicals, financials,
Mhm.
industrials, consumer discretionary, comm services. Those are rising up in our model as well. And even energy, which has been pretty much towards the bottom for a while, is starting to
Yeah.
perk up a bit. And those are all Trump 2.0 sorts of sectors. Um, inflation has reared its ugly head a little bit lately, and we saw the CPI for November that just came out, corroborating that. But to me, a little inflation can be part of this Trump 2.0 approach to stimulating the economy. It can help us not only not only is it a reflationary approach part of a strong economy, but it also can help us inflate away the debt. So if you look at it
Right.
as a three-prong approach, you can inflate away the debt, you can grow your way out of debt, and growing includes cutting taxes. And people say, well, gee, cutting taxes, you got to offset that with some sort of cost spending reductions. Well, they are working on spending reductions with this new Elon Musk Doge approach, but also I think it's Data Trek, Nick Colas at Data Trek has looked at this back to 1960, and he found that no matter what the tax rates are, you get about 17% of GDP as tax receipts. 17% of
Wow.
GDP, no matter what it is. So, gee, let's make the GDP go higher. That's the way you grow your way out of debt. So you cut some spending, especially waste. You grow your way out of debt, and also you inflate away your. And when I talk about inflate away, I'm not talking about 9% like we had
Right.
at its peak. I'm talking about maybe as much as 3%, 2.5 to 3%, rather than trying at all costs to get down to below the Fed's 2% target. And I think it seems to me that the Fed is actually recognizing that. They're actually talking about cutting again this month, even though some people are saying, no, don't do that. Inflation's too high. I think a little bit of inflation is fine as long as the economy is growing really strongly.
Right. Well, that's a great point. I never heard that statistic you gave out about 17% of receipts. I mean, I think that's fascinating. I think that my whole life, my whole career, and I'll say in that second book, there's an actual chapter about, from Williams, who was shadow statistics, and he was saying that all along, even though it's being reported at 2 and 3%, inflation literally was growing at 5 and 6% below the surface. If you look at anything except a computer chip, if you look at the price of tickets at your sports games or anything of the like, I believe, and again, I'm not a conspiracist theory, this idea of zero inflation or 1% inflation was always make believe. And the worst thing that a government fears is actually deflation. It's the thing that has always been since the Great Depression, the big fear of the government. We don't want deflation, although running for office talking about lowering prices sounds pretty cool. It's the biggest fear that there is for anybody because people will hold off their purchases waiting for lower prices and everything will spiral down. So that's just my take of it. What I just find fascinating again, um, at my advanced age, I continue to try to learn from the best every time. And you can mention your portfolios. Uh, it's transparent as can be. When you guys issue a new portfolio, whether it's a dividend, whether it's this or that, and you're reached out to by many people to do that, I look up and see, hey, what made their portfolio? And I'm always looking for ideas. I think people should do that. The other approach is to say, the Sabrient Systems is a pretty cool team. We'll just buy their product, and that's a pretty good approach too. So it's really a pleasure reconnecting. I will know, and I'll just say it again. I have approached you guys with something that I took my magnet model and put on more quality levels to look at trustworthiness of companies, and the facts portfolio has now outperformed the S&P, which is not its target, over 13 years. The real target is the Russell 1000 value, because I want to add one thing you can add on to that. While you say tech ranks high for you, what I don't see in your portfolios is these very, very high price to sales, very, very high valuations in companies. It's more of creating this ratio, looking for good, strong growth, accelerating revenues, margins, but then factoring in a ratio of what's the value I'm paying for this. So that's what, adding your GARP factor. So I'll just share that I don't call it cheating. I like to learn from the best. And I look at your portfolios. We have a few overlays, but this facts portfolio, I've been trying to get to the institutions. I don't have the power and strength that you do and your firm does. And when you've delivered, just throw out a number for me. I'm going to guess it's in excess with rollovers $20 billion over the last several years. Am I right?
Uh, yeah, it could be. Yeah.
And that's real quality. It's repetitive. So we're gonna bump up against time here. I am going to read David's book. I look forward to it. I want you to please send my regards to David. And on my last flight, by the way, I just saw Fly Me to the Moon. Maybe I'm a little bit late, but David was probably one of those guys in the consoles working on what he mentioned to me. His sub project was landing the lunar module on the moon. And man, that's called true rocket scientry.
Yeah.
So hi to David, best to your firm. Anything I forgot to ask you, I want you to mention your website and where they could find more information, Scott.
Right. You can learn more about the book and also the companion product that we sell that helps you if you want to follow what we do. That helps make it a lot easier, do a lot of the work for you. If you go to davidbrowninvestingbook.com and davidbrowninvestingbook.com, but you can learn more about Sabrient and read my full, as you said, lengthy monthly market commentaries at sabrient.com.
Well, fantastic. And I'm just guessing by the length of it, Scott, as soon as you complete one, you have to start writing the next one because man, you don't waste any, you don't save any ink. You really let it fly. And anyone who wants to read that should, have a cup of coffee and enjoy it. And there's a lot of meat behind it. So let me say one more time, Scott, thanks so much for joining us on WealthWise. Thanks for the articles that are appearing in the Pro Investor Insights. And the next issue is coming out in just a couple of days. And we really appreciate your time and your contribution to both the video and the newsletter. And I want to wish you a happy holiday.
Happy holidays. Thanks for having me, Jordan. My pleasure.
Fantastic. Last thing, please make sure to say hi to David for me. And we need to sign off. It's Jordan Kimmel on a great episode of WealthWise. It's Scott Martindale, CEO of Sabrient Systems. Everyone should take a look at them and see what they continue to repeat and do right. So thanks again for the time.